Okay, so really what we're doing, I mean, the purpose of today is to finish up the comps here, and I want just to quickly go over what you should have done for homework, which is laying out the quarterly reports. I want you to go quickly through, we did one example on Thursday, and what I was just mentioning before was looking at the income statement to lay out, just as we've done before, the revenue and the expenses. So the only difference about the expenses is we have to extract depreciation and amortization from the SG&A. So we laid out net sales and membership fees just as is, merchandising costs was cost of goods sold, and the SG&A of 2145, we had to subtract the depreciation of 205 from that in order to make sure that we have depreciation laid out separately. And the one thing that I was mentioning to caution is the depreciation we found, here's 205, in the cash flow statement, and although in this quarter the cash flow statement lists 205, and that's the depreciation that we're going to lay out. And the Q2 and Q3 reports, they don't have a 12-week cash flow. They have a year-to-date cash flow. So you have to be careful of, in Q2, it's not 12 weeks ended period, it's a 24-week period. So you have to take the cash flow that's reported, which is 411, and subtract the prior quarter's depreciation to get the actual 12-week depreciation in that quarter. That's all I mentioned. And that got us down to that got us down to other income. There are two lines of other expenses, pre-opening expenses and asset impairments, which we're assuming is going to be pulled out to the extraordinary event section. We have to move taxes with it. We'll talk about that. And we're just talking about the other income section, in which they combined interest income and other income, and we really need to separate that for analysis purposes. Right? We want EBIT and EBT, and we want other income to be separate from that I, which is interest income and interest expense. So interest expense is completely explicit, but interest income and other is grouped together. So we want to do a quick word search to look for interest income and other, and that should give us this table here, which lays out exactly the components of the interest income and other. And here is the straight interest income. So we want that in our interest section, which is 11. And so it's income. So because it's offsetting an expense, I recommend putting that in parentheses to show the difference between that and the expense. So we have the expense of 11, sorry, the income of 11 and the expense of 27, just related to interest. So now we have our interest section separated from just what's other income. And so we laid out other income here. And they list other income. What other income do they have? They have foreign currency transactions and other. So they just have one line item, where in the annual report, I think they had 2 line items. So that's 26. So we just laid that out as foreign currency transactions, gains and losses. 26, again, as a negative because it was income. Sorry, in parentheses because it's income. So I like listening, since expenses are positive, I like showing income in parentheses to offset the expense. Any questions on that? That would get you down to earnings before tax, which would be a little different than the one they reported because we've pulled out expenses from above, the pre-opening expenses and the asset impairments. So what that means is when you go to income tax expense, we're going to have a different basis of calculating taxes than they are. So if I scroll back to the income statement, let's see if we can get there quickly. Here it is, cash flow, here's income. We have, so they have 553 in income before taxes, a little bit lower because they have 2 sets of expenses, well, one expense and one income, that we've excluded. We've counted as extraordinary. So we don't have 553. We don't have 553. We have 562. So our taxes are going to be different. We pull out expenses, taxes have to go with it. So we need to calculate what the implied tax rate they paid in that period. And we did that by simply just taking, well, they paid $225 in taxes off of 553, so I divided, and I buried that division into the percentage number, so 225 out of 553 is an implied tax rate of 41%, and I applied that 41% to our 562. Right, to illustrate the fact that if we're pulling out expenses from above the line, taxes are going to go with those expenses. So there's our income before tax. So we've covered pretty much everything. They have this one last line item, non-controlling interests, which is -8. It's in parentheses, but you can see from 328 to 320. In this case, even though it's in parentheses, it's actually reducing. So you always have to check the logic. Up here, this is in parentheses, but it's it's reducing. These numbers are not in parentheses and are also reducing. So again, sometimes they change the logic of what the signs mean. So you have to be careful of that. So negative 8 is actually reducing. So I'm going to lay that out down here as a positive 8 to show. I like to show every expense is positive, of course. So that's going to reduce. And then we have our non-recurring events. The line items that we pulled out from above, which is the pre-opening expenses of 10. But when you pull expenses out from above the line to underneath the line, you need to tax affect them. So I listed this as 10 times 1 minus the tax rate. And it's got to be the same tax rate that we utilized above to make sure that the bottom net income report will tie with the net income as reported. And did the same with other items. They had 1, negative 1. So I show this as negative 1 times 1 minus the tax rate. So when you remove that, you have your net income as reported. That should match what they reported. So 320 matches our 320 now. So good. So we've proven to ourselves that everything is flowing correctly, yet we still have our adjusted net income that's of which all the one-off expenses have been pulled out. This is what we want. Any questions? And then, of course, we laid out the shares to calculate the earnings per share of each, 74 and 73. 74 and 73. Questions on that? Okay, so now we talk about making LTM and calendarization adjustments. And one careful thing that you have to do with the comps is to make sure that the time frame of all the comps, of all the companies that you're comparing against, are in the same time frame as the company that you are comparing. So in other words, we're using Walmart as our basis of comparison. And Walmart has a year-end date as of January 31st, 2012. January 31st. In this case, January 31st, 2012. So there's two things we need to look at. In comps, we have usually year-end multiples. We have one-year projected multiples. We also have LTM multiples. LTM multiples is data from the last 12 months. In other words, if there's been anything reported after the final year-end date, if there have been any other quarterly reports, you'd want to make adjustable or adjusted data as of the last report date. So for example, in this case, even though we built the model off of the annual report, off of the year-end, Walmart had at the time released 2 quarterly reports, a Q1 that was as of 4/30/2012, and a Q2 that was as of July 31st, 2012. Right? Which means technically you can get data for Walmart, 12 months data, annualized data, as of July 31st, 2012, which is a lot more current. I think we wrote this in September. Right? So how do you do that? Well, you'd simply take the year-end data and you would add the first 2 quarters, right? But that's going to give you 18 months of data, right? 12 plus 3 plus 3. So in order to get data that's equivalent to 12 months, you then need to subtract from this the prior year's Q1 and the prior year's Q2. Right? So you have now data from December, you have data from December 2011, sorry, December 2010 to January 2012. That's 12 months, right? If we want data all the way to July 31st, 2012, which is another 6 months, right? We need data from July 31st, 2011 to July 31st, 2012. So we need to X out everything from, let's say this is December 31st, 2010 to June 30th, 2011. Right, so Q1 and Q2. So if you subtract out Q1 and Q2 of the prior year and add Q1 and Q2 of the current year, then you have the last 12 months data as of July 31st, 2012. And that's how LTM works. So very simple. So all you need to do is just look up what quarterly reports have been released after the annual report, add those quarterlies, and subtract the same quarters from the year before. That's the only thing you need to know. So in other words, that would give us LTM data. So we have year ends. That would give us LTM data. LTM data as of July 31st, 2012. So now we have two sets of data. We have the year ends, which is as of January 31st, and then we have last 12 months as of July 31st. So what that means is for Costco, we need to make sure that when we show 2012 Costco year end, it's not Costco's fiscal year end. It's an adjusted year end that's in line with January 31st, 2012. If we have Costco LTM, it's not Costco's last 12 months based on what its quarterlies have been reported. We need LTM as of January 31st, 2012 to make sure everything is in comparable seasons. And you have to do that with every company that you're competing against. So, for example, Costco at the time had an annual report as of August. So that's Walmart. That's what we're tracking against, right? Costco had an annual report year-end 2011. Let's do year-end as of 8/28/2011, right? Which doesn't, of course, get us to January 31st, 2012. If you want to get to January 31st, 2012, we'd hope that they ever produced more reports than that. And they did. They actually have a year-end. They actually have a year-end after that, don't they? They actually have a year-end as of 9/2/2012 as well. But this is too far ahead, right? Costco has August the year before. 9 is too far ahead. So how do we make an adjustment to get us to at least close to January 31st, 2012? How would we do that? What do you guys think? Sorry, Saad. How do we do that? If Costco year-end, go ahead. Somebody was saying something. Nick, what's that?
Could you just add a quarter, like you were doing LTM, except
add a quarter to what? Yes.
To the year-end for Costco.
Good. Yes. So okay. So if we add the next quarter, so I'm going to go back, dig up quarterly reports, we're going to add the next Costco quarter to the 2011, right? Because this is the 2012 is beyond the point. If I add a quarter to the August 28th, 2011, that would give me data as of November 20th, 2011. That's Q1. Still not enough, right? What else do we get? If you're more than a couple days off, then you need to calendarize. So the idea of calendarization is to make adjustments to quarters that are already reported, make fractional haircuts to get to percentages that are closer to the year-end data. So for example, let's say, we'll take a simple example. Let's say we have a company that had an annual report, a year-end, ending November 30th, 2011. Let's say we had that, right? So we want to get to a year-end that's January 31st, 2012. So we add 1Q. 1Q gets us to February 29th, 2012, right? Which is 1 month away, right, from their year-end. It's 1 month away, right? So in this case, since it's a full month, 30 out of 90 days, in this case, we would want to only add 2/3 of this quarter. If we add 2/3 of that quarter, you're adding December and January, right? So if you're adding 2/3 of that quarter, then you subtract 2/3 of the prior quarter, right? And that would effectively get you LTM as of January 31st, 2012. That's calendarization, is haircutting the quarters. Does that make sense? I think that's what you're saying, Paul. Yeah.
Yeah.
Okay, but no, right idea. But so, okay, so based on that, how do we get from this to exactly January 31st, 2012? We need to, what? How do we get from February 12th? Some people say, all right, well, within 15 days, it's accurate enough. Let's say we want to be completely accurate. How do we adjust this to get us to January 31st, 2012? Yeah, so it's actually, if you count the days, 84 days. But right, if you want to be really accurate, you count the days, and there's 84 days in that quarter. You want to take out the last 12, right? So you do 12 divided by 84? No. You do 72 divided by 84. You want to multiply this by 72 over 84. You want to keep 72 out of 84 days, right? It's the last 12 that you want to X out, right? So you want, this is almost 2/3, a little more than 2/3 is what you want to keep. So for Costco, we take the annual report of 2011. We need to add the Q1, and then 72 out of 84 of the Q2, and then subtract the prior Q1 and the prior Q2 times 72 over 84. So whatever you're adding is subtract from the year before. That's Costco's year end. All right. This is something that you need to sit with and think about. When I was writing this, I had to stare at this for hours and make sure it was completely right. And I got it wrong. I'm going to do it again and do it again and do it again. Because it's confusing. It's simple math. It's just confusing. So let's go through it. So we need to, now that we have all the quarters and the annual and the 2011 laid out, we can now make our adjustments. And this is what you guys have to do for every comp. To lay out the quarters in between and the annual reports, and make sure you're adjusting to get to the company that you're comparing year-end and LTM in order for this to be completely accurate. That's the pain in putting together comps. This will take so long. So let's do it in the model. So again, we're replicating this process right here to get to what I call, all the way on the right, start at the top, year-end adjusted. So this is going to be the year-end adjusted to match the company that we're comparing to's year-end. It's supposed to match January 31st, 2012. So just as we drew on the board, we need to take, and this is just a formula, so equals in N6, the 2011, right? 2012 was September 2012. We wanted to January 2012. September 2012 is too far out. We also want to do 2011, right, plus Q1, right, which gets us to November 2011, plus Q2, which gets us a little too far, December 12th, 2011, and you multiply to that times 72 over 84. Right? So I took the 2011 plus Q1 plus Q2 times 72 over 84, and whatever I take in quarters and adjust for, I need to subtract the prior years. So I'm going to do minus the year before's Q1 minus the year before's Q2 times 72 over 84. And that'll give you 91,170.9. Here's their 2012. This is the LTM. This is adjusted for LTM and a little bit of calendars, adjusted for January 31st, 2012. to be in line with Walmart's. Right? And the point of this is, you know, reporting differences could have seasonality effects, effects on the markets, effects on different times of growth. This is supposed to adjust for that. So you get really accurate comps, if you believe in that. Everybody have questions on that? You guys okay with that? Want to look at the formula again? Here it is, 91, 170.9. Yeah. And then you just copy this down. You only copy it down, though, for the individual line items, not for the totals. The totals I recommend, total revenue I recommend, just you know, totaling top down as you normally would. But everything else, I'm just going to copy and paste that formula. So same adjustment for membership fees, same adjustment for cost of goods sold. Right? We don't have to do any pulling out depreciation and things like that. That's already been done in the individual quarters. And I'm going to copy to the right all the other total line items. So why don't you guys take a few minutes and let's try to match EBITDA. I'm going to go down real quick, but take your time. I'm going to copy the formula down for SG&A. And even depreciation. Oops, what did I do? I'm taking my 2011 column plus Q1 plus 72 over 84 of Q2, etc. Copy that down to depreciation. Even other income and interest income, same idea. And interest expense, interest income, just making the same adjustments with the exception of the totals. Take a few minutes and try to get there. Okay, let's continue. So the taxes, income tax expense. We need to reverse this back to the normal way of doing tax. The normal way. We've already done our haircut adjustments and things like that. You know, we're going to take these numbers as these adjusted numbers as reported, and make our LTM year-end adjusted calendarization adjustments as we had done any other individual line item. So the column H plus I plus J, 72/84 of that, et cetera, all that will apply to the taxes. So we are adjusting the tax number. Yeah? 918.4. And then so we're going to back into what was the implied tax rate based on that adjusted number. 918.4 divided by 2519, 36%. Copy to the right. Okay, you see what I'm doing? Same thing with these, with the non-controlling interests, right? We're adjusting. This isn't projections. We're adjusting what's been reported historically. We make that adjustment and then copy to the right all these totaling line items. You guys okay with that? Even the non-recurring events, although they're probably not going to really go into our analysis, let's continue to do that. The only thing you don't adjust is the shares. Shares are almost, shares are accumulated like a balance sheet line item, right? So when you make adjustments, and we'll learn this in the LBOs as we're adjusting models and things like that, you do period adjustments to the income statement, but to balance sheet items, you don't do period adjustments because balance sheet is an accumulation over time. So the question you want to ask yourself is, as of January 31st, 2012, what was the closest number that reflects the accumulated number of shares they had at the time. So that is the second quarter. So you would use the Q2 share count here, which most closely represents the number of shares as of January 31st. Right? You don't take 2011 plus Q1 plus Q2 minus Q1 minus Q2. We'll copy the EPS formulas to the right. Any questions on that? Okay. Now we have to think about LTM 2012. And this is a bigger problem because we have to get to July 31st, 2012. Right? So the question is, and why don't you guys think about that and let's talk it out, how do we get from, or how do we get, with all the information that we have available for Costco, how would we possibly get to July 31st, 2012? How can we do that? So what you have to do is you have to take, there's a couple ways to do it, right? But I think that the quicker way is to take the 2012 year end, which is a little bit further out than July 31st, and cut out that last portion from July 31st to September 2nd. That's a part of Q4. So that's 33 out of 119 days you want to cut out. So that'll get us, though, that will get you from September, September, well, I'll give you the exact. It's actually August 29th. They reported it a little bit different. They added days. August 29th, 2011 to September 2nd, 2012. That's their annual report. So if you cut out August 1st to 9/2, it'll give you August 29th, 2011 to July 31st, 2012. But this isn't now 12 months, right? We need to add 29 days here. We need to add from July 31st to August 29th. Right? We need to add a portion of the prior Q4. We need to add Q4 from the prior year. Now the problem with Costco is, I know I mentioned before, whatever you subtract from one quarter, you want to add the same amount. In Costco, it was a little bit different because Costco reported each year differently. So it wasn't like they reported every year 360 days, 365 days, 365 days. They reported, this is like a 53-week year, and the year before was like a 52-week year. So there were some days off. So I had to count the exact days that I wanted to get me from, I needed to add literally August 1st to August 29th, which was 28 days. So I need to add from Q4 28 over 100. There's 112 days in that Q4. There's 119 days in this Q4. You just have to go in and count the days. Just math. So what I did was, looking at the model, you took the 2012, which is as of September. You need to cut out the last 33 days from July 31st. You cut that out, and then add in the prior July 31st to get us to an LTM that's from July 31st to July 31st in line with Walmart's LTM. That's what you have to do. Now, the first problem on top of that is Q4 is not reported. They don't report and produce a Q4 quarterly report. When it gets to Q4, they just produce the annual report. Right? So we have to back calculate into our own Q4. So we had to set up Q4 columns, which you have, and we had to figure out what Q4 was by taking the annual and subtract the prior 3 quarters. So for revenue, we had to take the 2011 minus Q1 minus Q2 minus Q3. And you had to do that down all the line items. Whatever's left over. So that the sum of Q1 to Q4 equals 2011, obviously. And you can do that all the way down. I'm going to stick with doing it just for the line items and then copying the totals over. So just the hard coded line items to get Q4 data, just the individual detailed line items, my other income line items, interest expense, interest income, income tax expense, non-controlling interests, so this is what I had done. I just adjusted the actual line items, and that way the totals I just copied across. Oops. And the metrics I copied across. And did the same for Q4 2012. So now, these formulas are going to all be identical for Q4 2012. So you can copy this whole column over. Just be careful of the effective tax rate. The effective tax rate, we had hard-coded. We're going to apply this as the income tax expense divided by earnings before tax. I'll give you guys a second to catch up once I have this done and to check formulas. And then for the share count, again, you need to think about what are the shares reported as of Q4 2013. That's identical to 2011. It's the same date, right? It's September 2nd. Well, no, it's August 28th, 2011, right? Q4 ends August 28th, 2011. That's the same as 2011. So I'm going to have the Q4 equal to 2011 Q4. So take a second, see if you can, take a little bit of time, see if you can match this. Okay, it's the same exact process for the Q4 2012. So what we can actually do is just, nothing here is hard-coded. These are all formulas. It's the same format of formulas, so you can just take this whole column and copy it for Q4 2012. I'm going to take this whole column. I'm going to copy it and paste it here. Same idea. So we now have identified each individual quarter. So you might have to do this for comps. And we can now make our adjustment to get to an LTM or the same LTM that's in line with Walmart, which is July 31st, 2012. And we said on the board we're going to do this by taking the year-end 2012, which is as of September 2nd, we need to subtract out 33 out of 119 days of Q4 2012. So minus 33 divided by 119 times Q4 2012. And then add in 28 divided by 112. 28 divided by 112 times the Q4 of the prior year. And that should give us effective data as of July 31st, 2012. So it's M7, the 2012 year end for Costco, minus 33 out of 119 of Q4, plus 28 out of 112 of Q4 2011. And again, we need to Copy this formula down for each individual line item. I have to fix this revenue growth here. This revenue growth doesn't make sense because it's pulling from a quarter, probably. Yeah, this year-end adjusted, we don't need that. Continuing down, SG&A, the individual expenses, depreciation, amortization, other income, interest expense, interest income, taxes. Remember, taxes we're going to do straight. Oops. Non-controlling interests, pre-opening expenses, and then we'll copy over all the total formulas, revenue, COGS, gross profit, margins, SG&A, EBITDA, margins, EBIT, total other income, total interest, EBT, tax rate, income before non-controlling interests, net income as reported, net income adjusted, then the adjustments. And for shares, we want a share count that's most closely related to the time period of July 2012, which was in the Q4 period, which was the 2012 year. It's the same as the 2012. This is as close as you're going to get for shares. It's within this Q4. It's within this Q4 period, which we linked in from 2012. That's what you would want. So we now have our underlying data, finally, that we can use to create our multiples. This is the complexity in the comps, and this is when people ask you in an interview, how are you doing your comps? This is exactly why people don't want to hear why I download them from Capital IQ, right? Because we're getting a lot more specific. Arguable if it's worth the time, but this is what they look for. Talking about an analyst's role, attention to detail, things like that. Downloading stuff from Capital IQ doesn't get into this level of detail. So, okay, so, that was the kind of bulk of the details there that hopefully, you're probably seeing some of that already, but just to make sure you have all that stuff ticked down, and more importantly, to make sure that you can speak to that in the interview. So now where does this all go? So here is the comparable companies output tab. So we've done some others for you. Again, arguable, well, it's tough to find actual comps for Walmart, yeah, because it's so much bigger than these companies. But let me show you how we'd link them in. I prefer two tables, the table that has the output multiples, and then underneath a link into the underlying data that is used to make the multiples. Just that extra step helps avoid some error proofs. If you see multiples that are jumping around and just look funny, you can easily kind of scroll underneath to see, is there like an LTM sales that dropped from 71 to 40 billion? And then there's something wrong, you pulled in the data wrong. So I just think that this way kind of helps avoid some error and is easier to proof some of these items. So underlying data that make up the multiples, and then you do the multiple divisions up in the output. So Costco, we have sales, EBIT, D&A, EBITDA. So the sales, I'm going to pull in 2012 sales from the Costco comp. Even if you don't have all these numbers tied in, then still link in the sales. And when I say 2012, I'm talking year-end adjusted, right? In line with Walmart's 2012 year-end date of January 31st, 2012. And I can easily copy to the right because the next two columns is the LTM and the 2013 estimated. Right? So these are the three columns we're going to utilize. 2012 year end, we've adjusted to match Walmart. LTM, we've adjusted to match Walmart, and then 2013. EBIT, same thing. Pull in 2012 EBIT, and then copy to the right to capture LTM in 2013. And you can continue, right? D&A, EBITDA, I'm just going to pull everything in as reported, D&A. EBITDA. Earnings per share. Now, for earnings per share, I'm going to use, I'll make sure it's done accurately everywhere else, yeah. I'm going to use the diluted and adjusted, right? Obviously, everything's got to be on an adjusted basis. That's the whole point of pulling out non-recurring events, right? We listed the reported earnings per share just to make sure we're matching the reported to make sure that we're adding everything up properly, but it's the adjusted that we use for analysis, and the diluted. We're doing diluted share count, diluted shares, diluted EPS. So in the comparable companies, we're going to pull in the diluted and adjusted earnings per share adjusted, diluted in the year-end adjusted column. Lots of adjustments. Copy this to the right. That's the right way to lay out the columns. Okay, and we'll use this to create our multiples. You guys have this? Take a second.
Could you go to the depreciation line on the actual cost of them?
Mm-hmm. All right, now we can use this underlying data to calculate our multiples. But first, we want to pull in Costco's stock price, market cap, enterprise value. Remember we did that last week. Stock price is also on the Costco comp tab. When we diluted the shares, 96.94. Market cap, also on the Costco comp tab. After we diluted the shares, we calculated market value. And we calculated enterprise value. Costco comp. And so with this data, now we can calculate our multiples. And so we have price to earnings, meaning share price divided by earnings per share. So the numerator is going to be the share price, and the denominator is going to be the earnings per share. I'm going to anchor the reference to the share price, F4, so I can copy this to the right. So F8 equals C8, anchor that, divided by, I'm going to link over to the 2012 earnings per share for Costco that we had calculated before. And I'm going to copy this to the right. So if you see major swings in the multiples and think, well, something must be wrong, is that really a reporting thing, or did Costco really, or are we linking something wrong? We can easily look down and see, if we're pulling in something wrong. Enterprise value to revenue. You take the enterprise value, anchor that, divided by the sales in 2012, copy to the right. Pretty consistent. Right? Enterprise value to EBIT, take the enterprise value, anchor that, divided by EBIT, and copy to the right. and enterprise value to EBITDA. So this is what you should have. Okay. So yeah, here's an example of, I clearly made a mistake here. I had 41 in 2012 and dropped to 11. So I must have linked something wrong. I had an enterprise value to DNA in 2013, right? So now I can see I linked to the wrong thing here. Okay. All right. This is what everyone should have. And our comps are done, right? We have to do that for every comp. Okay, what is this? How do we explain this? What does this mean? How do we analyze this data? Where do we begin? Let's look at the PE multiples. First of all, there's a couple questions to ask. Which multiples do we look at, and what time frame? And there's really no right answer. I mean, you kind of have to, kind of eyeball everything and kind of come up with some conclusions. But I do want to talk about what the difference is. So in other words, the PE, okay? Remember we spoke about what's the difference between analyzing a PE multiple versus an EBITDA multiple? What's the major difference? What does one provide if the other one doesn't? You guys remember?
Our question of its market value.
That's a precedent transaction as a premium.
The PE multiple is using market cap of 7 billion for the company that was good step over.
Yeah, so the PE multiple is a multiple after depreciation expense, after payments to lenders, right? Because earnings is after depreciation is after lenders versus EBITDA. EBITDA is before interest, before depreciation. And the numerator, the price, the stock price of a company, and an investor prices stock after lenders have been paid. Whereas enterprise value is market cap plus net debt, before debt. So the PE multiple contains the effects of the capital structure. So if companies that you're comparing to have vastly different capital structures, the multiples may not be in line. That might explain why somebody like Costco has a much higher multiple, PE multiple, than the other companies. That might explain that. Or maybe just Costco is trading higher because of headline risk, maybe better earnings, or there could be a lot of reasons. But this might explain why PE multiples are, when you're looking at companies, are at a very wide range. Some are much smaller, some are much higher. Yet, of those same companies, the EBITDA multiples are more in line, because the EBITDA multiples do not have the effects of capital structure and depreciation. So it's just showing you the core value of the company's operations. EBITDA is before interest, before depreciation. EBITDA is literally just revenue less COGS and other expenses. So for that reason, a lot of people use EBITDA multiples when looking at the comps. And if you look at the EBITDA multiple here, it looks like they are, with the exception of Costco, in a quite similar range. 8.1, 8.1, 8.7, 7.6, 8.2. It's a pretty tight range. Yet, when you look at the PE, well, it's pretty close as well. Not as close, but 16 drops to 15, drops further to 13, and then Costco is much, much higher. There's still the differences, but the differences are more vast. Right? So you have to step back and ask yourself, well, what's more appropriate, right? If you're trying to value the business and you're concerned about, we talked about at the very beginning of valuation, that you typically just are concerned about the core operations of the business, the enterprise value EBITDA. We talked about tech companies. Tech companies look at revenue. And a lot of reasons for looking at revenue is because they could have certain costs in the business that make any other metric besides revenue negative. Or maybe their product is in a certain stage of development where revenue is the only basis that they have to value the business. Their revenue, or the multiples of revenue here, also bounce around a little bit. 0.8 and 1.2 is a big range for these companies when their EBITDA metrics are pretty much in line. You know, that's interesting. So this could be an economies of scale thing. I don't know. This could be maybe this company is producing, let's look at their actual revenue, underlying revenue. This is where this helps here. So this company is producing a much smaller number of revenue, but maybe they manage their costs such that their EBITDA is in line. I don't know. Again, when you're trying to analyze businesses of this size, you care about the underlying operations of the business as well. Enterprise value EBITDA. In terms of timing, it all depends on perspective. You know, one thing just to note is you do have to pick a multiple in a time frame and try to be consistent amongst all three methods of evaluation. You could think, all right, well, last year's is most indicative of what's to come. You could think next year's is most indicative. Again, the range is much tighter in 2013. Some people just use a high and low of the whole section. So what's the ultimate low here is 7.6, and the high is 11.7. Sometimes you'll exclude clear outliers. You know, this is where you want to kind of go back and assess and say, well, maybe I don't have enough comps. Maybe these aren't the right comps. You know, this is where you do a little bit more research. In this case, you also want to look at it, and of course, I mentioned the idea that Walmart is so much bigger than these companies. I don't even know if this is the right comp set at all. I don't know if there is a comp set for Walmart. Right? Maybe it shouldn't be by industry. Maybe it should be just big companies that are over $200 billion. Maybe that's the comp set. It depends. Yeah. How can it be what? With the stock price? Well, the stock price is relative, right? And that's the whole idea of the multiples, right? The stock price is arbitrary, right? It's the price in relation to the earnings that it's producing. That's important. I mean, Walmart is, you know, $200 billion and is producing an earnings per share that's, you know, only 50 cents more. So that's really what you're looking at. And then what does that mean for PE? Where's the PE? The PE Costco is bigger. So there's a lot of other reasons: supply, demand, market psychology, earnings expectations versus other meeting expectations, anything from litigation to that could impact their stock price. But you can't just say, well, 96 versus 73. It's 96 relative to the underlying income that's being produced by the business. And that's where multiples come in handy. Good question. So when applying all of these three methods, the DCF, the comps, the P-PAIDs, we want to come up with a range based on all this data. And the range can be quite subjective. That's the tricky thing about valuation. And we want to apply that range to interpret this into what would be a valid stock price for Walmart. So for example, for the comparable company analysis, I looked at all this and I kind of arbitrarily said, all right, well, this seems like it's all around. I kind of analyzed these two projected columns. I said 8 to 11 seems like a reasonable high and low. Now, some people take it literally and say, all right, well, 8.1 and 10.2. Or some people take the ultimate minimum, the ultimate maximum, 7.6 to 11.7. If you did that, I thought 8 to 11 was a valid range. You know, if you're 0.5 higher or 0.5 lower, it shouldn't really impact the valuation all that much. You basically want to see, is the stock price significantly higher or significantly lower? Should I invest? Should I sell? So let's assume 8 to 11 is a valid range. And what you would do is you would go to the football field, where we have the three different valuation analyses and the results, and we're going to interpret the results into our enterprise value, equity value, stock price. So comparable company analysis, let's assume that we had a multiple of 8 to 11. I hard code. I don't link it into the actual analysis because you use the analysis and you step back and use logic and educated guesses to interpret a valid range. You might be excluding outliers, things like that. What we want to do is we want to say now, if Walmart was trading at the low end of its competitors, what would its stock price be? If Walmart was trading at the high range of the competitors, what would its stock price be? That's the way you think about this. So we're going to take Walmart's last reported 2012 EBITDA. Some people prefer to take its projected EBITDA. Some people prefer to take its LTM EBITDA. Just pick one EBITDA and be consistent throughout all the methods for your evaluation. I'm going to take 2012. So I'm going to pull in Walmart 2012 EBITDA. I guess you can take it from Walmart Comp or from the model. It should be identical, 34688. And to get the enterprise value of Walmart, if Walmart was trading at 8 times, you multiply. Enterprise value EBITDA is the multiple times the EBITDA. So that's the idea here is if Walmart was trading at 8, the low range of the comps, what would its enterprise value be? 277. Right? What was Walmart trading? What's Walmart's comp? Walmart is at 8.2, so it's kind of there. Football fields. Now, we're going to use Walmart's net debt to back into the equity value. Right? Equity value plus net debt is enterprise value, so enterprise value minus net debt is equity value. So let's get Walmart's net debt. We did it in the DCF, if you guys remember. Where is its net debt? Here it is over here, net debt plus non-controlling interests. Remember we did the example, the interview example where we include non-controlling interests? Perfect. Everything's matching. And then we take the enterprise value minus net debt to get to an enterprise value, equity value, I'm sorry. And then we divide equity value by shares outstanding to get the implied share price based on the low end of the comp range. So I'm going to get the shares outstanding. We also had it in the DCF, 3365.7. And we divide the equity value divided by the share price. So based on the low end of the comp's range, it could be trading as low as $67. Now, if you said, well, I'm going to take the literal high, which is like 8.1, it's not going to, it changes it by $1, right? So my point is to not get too hung up on the little decimal details. That's the point of getting a range for each of these analyses. And we want to replicate this process for the high end. You guys okay with this? Where if the multiple is 11, we multiply by the EBITDA. I'm just going to pull the EBITDA on from the left there. I'm not going to go back to the other tabs and going back and forth. You multiply to get 11. Probably just anchor everything and copy to the right. Pull in the net debt. I'm just going to take the net debt from the low. The shares I got from share count here. This should be the diluted, right? Yep, diluted. Yep, diluted. Good. Good. I did double check that. Equity value is the enterprise value minus the net debt. We'll take the same shares and we'll divide again. Right, so the idea is based on the comps high and low, where would Walmart trade? Anywhere from 67 to 98. It's a big range. Again, it was tricky because Walmart now was around like $80. Right now, when writing the book. When I first chose Walmart, it was at like 53. So no matter what analysis we did, everything pointed to it was going up. And it did. It went up like $20. So it was easier analysis. Sometimes you're caught in the middle like this, and it's tough to make a judgment. We'll see. We'll narrow it down to a judgment. But again, you want to look for those clear-cut opportunities where everything points to the share price going up if you're using this for investment purposes. I also like to track this against the 52-week high and low. So where has Walmart's stock price been over the past 52 weeks? To get the 52-week high low, you guys know how to get that? You can just go to Internet Explorer, to the Yahoo Finance, and right on the front they have the 52-week high and the 52-week low. And if we do it now, it's going to be different than what they had when I wrote the book. So let's do it. So when I did at the time, the book, the 52-week low was 56.3, which is basically where they were at the time, 56.3, and the high was 77.6. So this isn't really a valuation method, but it helps you track where the company's stock price has been in relation to where you think it's going. So I'm going to use the share price and back into the implied equity value and enterprise value based on that share price. So when the share price was trading at $56, what was Walmart's enterprise value and what would Walmart's multiple have been? So I'm going to take the same shares, number of shares. I'm going to multiply to get the equity value. I'm going to pull the net debt over. I'm going to add an equity value plus net debt to get enterprise value. And I'm going to pull the EBITDA. And I'm going to divide enterprise value by EBITDA to get the multiple. You can do the same thing. Just copy to the right. So when the company was at 56, that was a 7 times multiple. When the company was at 77, that's a 9 times multiple. We're getting ranges that we will compare. Everyone okay with that? Need a minute or two? You guys all right? So we took the 52-week high low. We looked at the comps. Let's look at the precedent transactions that we did last week. And let's also come up with a range. I'm going to stick to using the EBITDA because we've started using the EBITDA. If we look at equity value to earnings, a lot of it's non-existent. Everything from 24 to 0.4 to 50, it's all over the place. And again, even this data isn't sufficient. It's dated. That's the problem with precedent transactions. A lot of the data isn't available. But if we're forced to identify a range, we can have everything from the ultimate low was 11.7, the high was 16. So you can round that to maybe, I did 12 to 16. And 12 to 16. That's a good range. I wouldn't go beyond 5 points in the range. 12 to 16 is a 4-point range. That's my opinion. 5 to 7 points is a wide enough range. So 12 to 16. Let's do that. I'm going to go to my football field, and I'm going to, same idea as the comparable company analysis. I'm going to do low and high. You know what? I could probably even just copy. No, actually, I'm going to get some reference errors, aren't I? I'm going to do low is 12, high is 16. And I'm going to back calculate into what that means for enterprise value, equity value, implied stock price. So I'm going to pull in the comparable analysis, the EBITDA. I'm going to multiply. I'm going to add the net debt to get from enterprise value. Sorry, subtract the net debt to get from enterprise value to equity value. And then I'm going to divide to get the high-low, which is 108 to 149. So really high. But we mentioned, understandable because comps include a premium. Right? But still, this is really high. It's higher than the high end of the comp range. Reasons for that. Yes, it includes a premium, and on top of the fact that the best deals we could find was in 2007, a period where the market was, everything was high, right before 2009, before everything crashed. So, tough analysis to look at. You guys okay with that? There's a couple ways to do the DCF. So some people, now if you notice when we did the DCF, we ran some sensitivity. Some people run sensitivities on multiples to get a range of multiples. Just for the book, I just took the low and the high stock price based on the two different methods, the EBITDA method and the perpetuity method. Some people like to expand that a little bit, adjust the variables. There's a lot of different ways to analyze the DCF. For now, to keep it simple, I'm going to take 88 as the low, 97 as the high. And I think in this case, I linked it in. Well, it's funny. In the book, I have slightly different numbers. But okay, close enough. 88, 60. So what I'm going to do is I'm just going to pull in. You could hard code it. I hard coded everything else. I'm going to start with, like the LTM, I'm going to start with the price per share and work down. So I'm going to take the low DCF. From the DCF analysis, 8860, and the high, from the DCF analysis, 9714. And like what I did with the LTM, I'm going to take the stock price and back calculate what the implied equity value, enterprise value, and multiple ranges would be. So I'm going to take the diluted shares and multiply. I'm going to take the net debt. I'm going to add. And I'm going to take the EBITDA. I'm going to divide, which gives us a range of 10.1 to 10.9. So even though for some reason in the book the numbers were slightly different, it gave us a range of 10.1 to 10.8. So this is my point. Things will adjust a little bit, but when we look at big ranges like this, it's not going to make too much of a difference. Are you guys okay with this at this point? Yeah? Question on this? So what does this mean? So if you scroll down, we get to, at the time the current value is $73, we get to just a graphic representation of all the different, this is usually what goes in your pitch books, things like that, of all our different analyses. And we use this to help conclude where our stock should be trading at. Right? So this is where it was. So this line's in the wrong place. We've got to move the line. The line should be, was at 73. It's got to be under 77. Probably about here. This is where it is. 73.82. Okay. Okay. This is where it is now. The high end of the 52-week range. Right. Comp suggests maybe there's room for it to go up. P-pays suggests if you were to acquire the business or people are looking to buy the whole business, would value it much higher. Again, we know our reservations about P-pays. And the DCF suggests that it might be a little bit higher, albeit this is a very tight range. If we were to expand it, I don't know, maybe it'll expand up or maybe it'll expand down. We looked at how to analyze the DCF. How would you read this? Say again? By. I don't know, maybe. I mean, the difficult thing is, the tricky thing is, I mean, well, how would you look at one versus the other? What's the value in looking at the comps versus the other three? Start there. What's the value in looking at the comps? We're talking in the very beginning about strengths and weaknesses of each method. What's the value of looking at the comps? We can be asked this in an interview.
That is up to date.
Up to date, most current. It's the most current perspective. And the LTM helps us say, okay, so does that mean it's higher than where it's been or it's lower than where it's been, right? Based on its competitors. What's the drawback?
That competitors are not really.
Are these really its competitors? Which is important to see where they're at now. These might not be the right competitors. As you get bigger, would the value decrease? And another drawback is maybe all its competitors are overvalued or undervalued. Costco was valued pretty high. We talked about the PPAs, right? About the drawbacks. You talked about the drawbacks, dated analysis. What are the DCF? What's the benefit of the DCF? What's the benefit of the DCF? In contrast to the comps. Technical. It's based on the model. This isn't really based on the model. I mean, okay, maybe a projected EBITDA, but that's not. It's based on cash flows that you've projected 5 years. What's the drawback of the DCF? The assumptions on the DCF, and the terminal value is based on perpetuity, things that are maybe not so, well, I don't want to say technical, but not as robust as a model. Your model projections could be off. Those are other things that are difficult about a DCF. And so the hope is that all these three methods would, even though they all have major flaws, they all have its own benefits, and they all have very unique benefits each. So if they all fell amongst a similar range or told a similar story, it should be a good indicator as to where the stock price should be. So think about when I first analyzed this, and they were at 56. Everything was above. Even if you ran high-level and low-level assumptions, everything was still above. So you would have to estimate, unless there is a major company event that's unforeseen, then a company like Walmart that's odd, the stock price had to go up, and it did. In this case, still, it shows that there's room for it to increase. And today it's at like $88, $89, right? It did end up going up further, right? Quite a bit further. So this had painted the picture at the time that it could go up further, but who knows? You know, you never know. One day at Walmart might say, well, we're cutting our earnings and this and that, and then the whole picture is going to change. So there still is always a risk involved. But you want to look for consistency in the story. And sometimes it'll be inconclusive, right? Sometimes some bars will be under, some bars will be over, and then it's tough to draw a conclusion, and, you know, that's something that you have to face. But there's a common interview question that comes out of this. Which of the three methods always would give you the highest range and what would give you the lowest range? Common interview question. And why? What's the answer? You know it.
What precedent transactions give you the highest?
Right. Precedent transaction gives you the highest because it includes a control premium. What about the lowest? Now, it's a little bit tricky because I've heard a couple of different answers, and some people are real. I don't agree that there's one specific answer. Some people say the DCF gives you a higher result than the comps because models tend to be aggressive. But now, what if you build conservative models? And I've seen people in interviews like, you have to give them that answer. I don't know why. So it's important if you're asked that, just to make sure you're explaining yourself. Well, the DCF could be higher if your model tends to be aggressive, but if you're conservative, the DCF could be lower. And the comps, it depends on the state of the market. Right? If the market's overvalued, the comps could be higher than the DCF. Or in a depressed environment, the comps could be lower, right? So it's really important to compare these two, right? And you look at the comps versus the DCF, where the comps is based on what the public views, and the DCF is based on your model. And this is really what you kind of look at when you are thinking about where the stock price should go. Should it go up or should it go down? If our DCF was way under this line, I'd second guess looking at this, right? And again, we still have to expand variables. What if the WACC was a little bit different? What if the beta was a little bit different? Right? But it looked like, and the way I concluded is, yeah, the stock price could go down a little bit. It could reset back to its normal levels. But assuming their EPS continues as planned and as projected, their stock's going to go up. And believe it or not, it did exactly that. It went up a little bit. It dropped to around the mid-60s if you look at the history. And then it jumped back up, and now it's about 88, 89. So the conclusion is, this is a good way to look at the value of the stock, and it's proven often. It's not the ultimate way, and it could hurt if the earnings does not fall in line with what you're projected. So there is very much an art to this, and it's about really understanding where your upper and lower boundaries are, and the interpretation. But this was a good case. Right? What's the stock price at now? Did you figure it out? I think it was around 88. So we'll use this tomorrow. We're going to use this model to start looking at raising equity, raising debt. We did a little bit of that. Buying assets, divesting assets, and then we'll start to get into the mini merge model. But that concludes. We're done with the book finally. Any questions?